Welcome back to our accounting masterclass. Today, we're diving into one of the most important financial statements, the income statement. I'll explain what it is, break down its main components, and walk you through 3 practical examples. Part 1. What is an income statement? The income statement, also called profit and loss statement, shows a company's financial performance over a specific period, monthly, quarterly, or yearly. It reports revenues, expenses, and the net profit or loss for that period. Part 2. Main components: revenue, sales, total income generated from selling goods or services, cost of goods sold, COGS, direct costs to produce or purchase goods, gross profit, revenue minus COGS, operating expenses, cost to run the business, rent, salaries, utilities, etc. Operating income, gross profit minus operating expenses. Other income expenses, non-operating items like interest, gains, or losses. Net income, final profit after all expenses and taxes. Formula: net income equals revenue minus COGS minus operating expenses, plus or minus. Other items minus taxes. Part 3. Practical examples. Example 1. Service business. Revenue, $100,000. Expenses, $60,000. Net income equals $40,000. Example 2. Trading business with COGS. Revenue, $200,000. COGS, $120,000. Operating expenses, $50,000. Net income equals $30,000. Example 3. With non-recurring income. Revenue, $150,000. COGS, $70,000. Operating expenses, $40,000. Other income, $5,000. Net income, $45,000. Part 4. Why is the income statement important? It shows profitability, helping investors, managers, and banks assess a company's financial health. It's essential for decision-making, forecasting, and performance evaluation. If you found this helpful, give the video a thumbs up, subscribe for more accounting insights, and turn on the notification bell so you don't miss the next lesson, where we'll cover the cash flow statement.